He believes almost all of it has gone to China over the years. But with President Trump's tariff war, China is no longer buying U.S. soybeans. Income has plunged 20% on this farm over the last year because of that.
You voted for Donald Trump.
I did.
Do you regret that vote?
Yes, I do.
If you could say anything to President Trump now, what would you say?
I expected that you would do what was right and cut waste and fraud and all of those things that you promised us before we elected you in office, but you're not doing that. You're creating a disaster, and I don't know what America is going to look like if this continues.
China needs to make a deal with us. We don't have to make a deal with them. There's no difference between China and any other country except they are much larger.
She'll get you a refrigerated truck.
Ooh, you need the truck tomorrow? Can you guys fork a pallet jack into the back of the trailer for him to pallet jack him to the front?
This gives her a window into real-time shifts in the economy.
I was expecting the lower cost of a lot of just your everyday living things and hoping that he would make things better for everybody in America, because that's what we need.
In just 5 days, 88% of America's soybean export volume disappeared. Following China's retaliatory tariffs, 12,000 tons of U.S. pork orders were canceled overnight, a critical figure reported by the New York Post, citing USDA data. Across the Midwest, massive storage silos are filled to capacity with soybeans, while the Chicago Exchange's futures board is nearly empty. TV cameras capture the weathered face of a farmer. The beans are spoiling in storage, and our bank accounts are drying up too. On one side, there's a growing pile of crops that can't be shipped. On the other, export revenue has collapsed after just a few days of the tariff war. Is this a natural disaster? No, it's a man-made tariff storm devastating the livelihoods of America's farming communities. Tonight's big question: who's truly bearing the cost when the push to confront Beijing backfires, hitting rural America hard? 3 days after Beijing shut its doors to U.S. agricultural products, new orders from China dropped to zero. The USDA noted that since January 16, 2025, Chinese buyers haven't priced a single soybean shipment. Billions in revenue vanished, as if someone switched off a decades-long export engine. The following week, the impact deepened. Soybean imports to China from the U.S. fell 97% in just 7 days, alongside the cancellation of 12,000 tons of pork, a crisis the New York Post, citing USDA data, labeled catastrophic. In Iowa and Illinois, silos are overflowing with soybeans. Meanwhile, futures prices on the Chicago Exchange dropped nearly 2% in the initial reaction session. China's import halt shattered the logistics chain. Grain transport reports show a 66% drop in soybean export inspections at U.S. ports for the week of March 6 compared to the 3-year average, leaving cargo ships idle and the Mississippi River quiet, without the sound of towboat horns. At New Orleans, grain barge unloadings fell by over half from the prior week, forcing carriers to slash capacity below 50%, with many sailings canceled at the last minute due to insufficient cargo. The impact extended beyond transport. Oilseed processors hit the brakes too. Archer Daniels Midland, ADM, announced the permanent closure of its Kershaw soybean crushing facility, despite its 50,000 bushel daily supply to the eastern biodiesel chain. The reason? A lack of raw materials and market demand to keep operations running. Remaining plants cut capacity by 60 to 70%, shifted to maintenance, or rotated workers to curb losses. This collapse is just the tipping point. The U.S. soybean export market share has fallen from over 80% in the 1970s to 27% today, with Brazil now dominating at 55%. Reuters cautions that unless Washington eases tariffs, American farmers risk being confined to the domestic market. Transport stocks reflect the strain, with Flexport reporting a 60% drop in Pacific bookings since April 9, a decline CEO Ryan Peterson described as a steep plunge. In just 3 weeks, 88% of the soybean exports that once sustained the Midwest turned into a backlog of unsold goods. With storage full, the question haunting farmers isn't where to sell, but whether 30 years of market development burned to ashes in one tariff strike. How many farms will go under? How many rural towns will fade into ghost towns if this tariff storm persists? The tariff standoff between Washington and Beijing crossed a critical threshold when the White House approved a 145% duty on nearly all Chinese goods, framed as protecting key industries. This rate, 6 times higher than the 2018 trade war tariffs, marks the largest unilateral tariff the U.S. has ever imposed on a global economy. So far, there's no sign of de-escalation, even after a single negotiation call. Within 24 hours, Beijing retaliated with a 125% tariff on U.S. farm goods and indefinitely suspended new contracts for soybeans, corn, and pork. The USDA recorded the cancellation of 12,000 tons of pork, the largest since the 2020 pandemic. Soybean purchases from China plummeted 97% in a single week. The fallout spread rapidly. With U.S. soybeans hit by a 125% duty at Hainan, Chinese importers shifted to Brazil and Argentina, where record harvests are ready to ship. Reuters notes Brazilian soybeans for February delivery were priced at $420 per ton CIF China, while U.S. beans from the Pacific Northwest hit $451. Adding the 125% tariff, U.S. beans cost $60 more per ton than Brazilian ones, per AONVest's estimate. This price gap leaves Chinese traders with little reason to sign new U.S. contracts. This shift was deliberate. Since the 2018 trade war, Beijing has built strategic reserves and strengthened ties with South America. In 2024, Brazil supplied 74% of China's soybean imports. By Q1 2025, that share neared 100% as state-owned crushers secured Brazilian cargoes. In January, Chinese reserves purchased nearly 2 million tons of Brazilian beans, a decade-high monthly record. The tariff blow erased the U.S. price advantage and 30 years of market building in China in just 1 week. The North Dakota Agricultural Policy Research Institute estimates U.S. farmers lost over $2 billion in export revenue in the first half of 2025 due to the tariff wall. Cash dried up so quickly that co-ops took low-interest loans to rent temporary storage, avoiding a soybean dump as silos overflowed. On the Chicago Board of Trade, July futures dropped below $10 per bushel, a 2-year low, yet U.S. beans remain uncompetitive. Ship and Grain Logistics reports a 58% year-over-year drop in soybean bookings from the Louisiana Gulf to East Asia, leaving Panamax vessels idle or canceled. Analysts warn this could be a triple-speed repeat of 2018's trade war, restructuring the global soybean supply chain. With Brazil's weak real and 169 million ton harvest, China has no reason to return to the U.S. market until the 125% tariff is lifted. If the EU or India retaliates against U.S. beef, cotton, or corn, the storm won't stop at farms. The question won't be who wins, but how many farms vanish before the White House grasps the true cost of tariffs as economic power. This may be the grimmest harvest season American farmers have faced, forced to adapt daily to survive. In late June, Council Bluffs, Iowa's auction yard was crowded with growers selling 2019 John Deere tractors at 35% below purchase price to cover interest and fuel for dryers preventing bean spoilage. Nebraska Public Media reports a 4% drop in 2025 soybean acreage, with Nebraska losing 6%. 3 decades of Asian market expansion vanished with one retaliatory tariff. An Iowa research team estimates 12% of Iowa's corn and soy land, 2.7 million acres, loses money annually. Many farmers let weeds grow or enroll land in the CRP program, as buyers are scarce. Mark B., farming 600 acres in Webster County, says, "I used to plant full seasons. Now I lock the silo and cut power to save fuel. The beans inside are molding green. The ripple spreads." Deere & Company cut its 2025 profit forecast to $5 to $5.5 billion, projecting 10 to 15% lower equipment sales as farmers lack cash for big purchases. Successful Farming's January 27 auction saw unprecedented idle late-model combines. With Washington's 25% steel and aluminum tariffs, domestic coil prices hit a 3-year high, with hot-rolled coil up over 40% in Q1. A Farm Progress dealer survey notes combined parts, drive chains, and bearings rose 38 to 45%, averaging 42%. Fertilizer costs from Canada and Russia soared, wiping out spring 2025 profit margins. Even seed prices jumped 28% above pre-pandemic levels due to trade royalties and logistics.